Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. Art is on business this weekend. Luke McCarty is here. How you doing, buddy?
I am doing good.
The market is all over the place, and this is causing you to make some changes at the McPherson Financial Group because stocks and bonds are down right now.
Yeah, we've made some changes recently. If you go to our YouTube channel, you can see the changes we've made over time. You know, we did get less aggressive in December of last year, so that's helped our portfolios. However, to the start of 2022, right, stocks are down, depending what index you look at, 10 to 20%. Bonds are down, 9%. So going the last 8 times, the S&P 500 was down in a calendar year. The bonds finished the year positive. It does not look like this is going to be the case. So even back in 2008, when the S&P was down, bonds were positive. Going all the way back to the 70s and 80s, that's usually been the case. However, recently, right, bonds are getting crushed because of the interest rates. Mm-hmm. We've had certain stocks like Amazon, report bad earnings, down 10%. Netflix report, slowing of user growth, down 20 or 30%. So we've had some big moves in the equity markets. But what's really hurting most people's portfolios are the bonds. And we took most bonds out of our portfolio in December of 2020 because last year bonds were negative. This year bonds are negative. So we use different things, bond alternatives like institutional real estate, fixed indexed annuities, some hedged products, some buffered products. I mean, there's quite a few things out there you can be in, but right now is a really tough spot to be in a traditional 60-40 portfolio.
Do you believe that old advice, 60-40, do you think that is dead?
It's dead this year. I think long term, it's not really dead, but we're coming out of a 40-year bull market for bonds, right? The interest rates have theoretically been falling since the early 80s. Well, now it's the opposite. Now they're going up. So the last 40 years, that plan's worked great. But now and going forward with all these interest rate increases, with all this inflation, it does not appear the 60-40 portfolio is working very well if it's down 12% for the year.
I want you to hear this clip from Morningstar's Christine Benz. She's actually talking about the 60-40 and how it may not be the best method anymore.
No single asset allocation fits all people. If you're a retiree getting close to needing your money, I think you want to make sure that you have ample bond holdings in your portfolio because we could have further equity market volatility. And the last thing you want to be doing is drawing upon a portfolio that's simultaneously declining. So really use your own situation to position your portfolio.
I think Christine Benz pretty much said exactly what you did, Luke McCarty, but it's something that we also hear from Art McPherson every week here on The Art of Money, that our portfolio, it should be tailored to our specific circumstances.
Yes, it's definitely very specific to you and how much income you need from the portfolio. Do you need it monthly? Do you need it quarterly? What your age is, how much money you want to give away to the kids, as a legacy plan. I mean, everybody's plan's a little bit different, but there are some bonds that are currently working, and we have some of them in our portfolios, and those are high yield, short duration. That's very jargony, I know, but the high yield bond market's getting crushed, right? That's your 20, 30-year bond with a high coupon rate. Mm-hmm. Well, what we're doing is we're buying the high coupon in 3 to 5 years of maturity. So that way these interest rates aren't as bad to that bond because you're going to get your money back in the next 2 to 3, 4 years. So that bond play is still alive. Some other things that are working well, floating rate loans. When interest rates go up, the rates of those loans go up. So you're not actually losing money with inflation. So, it's definitely not for everybody when we speak to these certain types of investments, but every client here has a different portfolio.
And that's why that initial consultation from the team at the McPherson Financial Group is so important because let's build that portfolio to fit your specific circumstances. What's going to work best for you? 321-425-8550. Let's get on the schedule. You don't have to come in the next week, but just get on the calendar to meet with the team for the McPherson Financial Group. Luke McCarty, Art McPherson want to begin that conversation with you. And I know a conversation that you'll have is about annuities because, as you just mentioned, interest rates are up, but they're still low from a savings side. And there was a new poll from Global Atlantic Financial Group that found that 60% of adults believe that interest rates combined with inflation is going to make it more difficult to create that lifetime lifetime retirement income. What kind of options do you have to offer people who are worried about their retirement nest egg?
Yeah, so this is where we want to introduce an investment in your portfolio that does not move with the stock market. It does not move with interest rates. One of those options would be a fixed indexed annuity. So right now, those annuities are down 0 for the year. In good years, you're going to make 5, 6, 7, 8%, kind of like a bond historically used to, but the bonds aren't doing that anymore. So if we look at this from a bond alternative, it makes sense for a sleeve of the portfolio, for a piece of the pie. I think your exact question was more about lifetime income. When you think of an annuity and you annuitize, that's where you give all the money to the insurance company and they pay you out. If you don't get enough back, you actually lose money and the insurance company keeps it. Your kids don't get a benefit. We don't use those types of annuities. If we're using something for income, we may put an income rider on it where you get lifetime income, but there's still a death benefit potentially for your kids, for your spouse. It's not a give all your money away, get a monthly pension. So we keep most of our options open there by just adding the income rider for that lifetime income.
One of these conversations that I know, Luke McCarty, that you have with a potential client is how taxes are going to continue to affect people even far into retirement. And most people are surprised. They have these big tax bills. So what is the surprise? Why are people so taken back by a tax bill? And what do you do to help lower that bill?
I think a lot of people are taken back by the tax bill because you think you've paid taxes your whole life, you have this nest egg, and then you go to get it in retirement and you owe taxes again. So I think a lot of people don't realize that, if you have a traditional 401k or IRAs, well, you almost have to think a third of that isn't yours, right? 2/3 is yours, 1/3 is to Uncle Sam. And as we see, tax rates going up, government getting into more debt, trillions of debt, we're going to see higher tax periods during our lifetime. We also see with some of our clients that they actually spend more money in retirement, at least at the beginning, while they're retired than they did when they were working.
Okay, wait, so, why? What's the reasoning for people spending more?
If you think of a bucket list and you have one, but you've been working for the last 30 or 40 years, you probably haven't checked many things off of it. So, minus the COVID situation where we weren't traveling and doing a lot of things, I think a lot of that's opened back up. And, we have a lot of our clients doing a lot of travel now, or just even visiting the kids, the grandkids, having everybody together again. And just the not having to go to work aspect of being retired, you're going to spend more money, right? You're going to play more golf. You're going to eat more lunch after golf. I mean, I could think of a lot of things I could do if I wasn't my current age.
Do you find that people, when they initially retire, that they do that? They go crazy for the first 6 months, maybe the first year, and treat it like an everyday vacation, which is essentially what it feels like. But then they go, whoa, wait a minute, there's more to this. Like, I can't sustain this lifestyle forever.
Yeah, we have those clients that, have that sense of, I have to go do all of this right now and kind of overspend a little bit at the beginning. And then we try to reel them in a little bit. But most clients, if you've been a good saver your whole life and you have, a couple $1 million in savings when you retire, it's hard to spend it. And that sounds counterintuitive, but if you've kind of saved your whole life, and I don't want to call you a penny pincher, but it's hard to let it go. So it's usually the other spouse that's okay letting it go and spending more. You have the saver and the spender. But if you have two savers, the conversation switches to, okay, if I cannot get you to spend more money while you're living, what is your plan when you pass away, right? And does it still work with what you want to do if you have a lot more money, 20, 30 years from now than you do today?
So there was a great story that said that 70% of adults plan to have more fun and spend more freely over the next decade. So they want to make up for lost time during the pandemic. And the top of that list was traveling. So is that part of the conversation that you're having now when you say people retire and they spend more money, they get back out because of the pandemic? Are you having to create separate funds just to get back out and live their life?
Not necessarily separate funds, but we have some funds earmarked. We can put into your financial plan that you need X amount of numbers every year to go travel, or you need X amount of numbers for seeing grandkids or taking your family on vacations. I mean, you can think of any way or scenario you can spend money. I can put it into our system and we can plan out that says, hey, if you really are going to spend $20,000 a year on this outside of all your other expenses, it works, or maybe it doesn't work, or not with inflation, or only for so long. But yeah, we're seeing a lot of people get out more. One of the interesting things on the Google reporting, Google had their Q1 reporting. They didn't really do very well. The stock is down. but they mentioned how many Google searches are happening right now for travel. I mean, pre-COVID Googling for travel. So I think there's going to be a lot of summer travels, fall and winter. So even as expenses are going up.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174. 725.
Today's show has been a work of art.